Ladies and gentlemen, my name is Bill Dennis, EOTPROLIVE.com. This movie is to talk to you about the market sync and the market sync bias indicator. These are cycle-based indicators. They measure cycles in the markets. Cycles are one of the things that are very poorly understood and key to understanding the markets, as well as volume. It's something that you need to include into your analysis. I'm going to show you why. Market sync here, these dots measure the cycles. If they're below the red line, that means the cycles are biasing to the short side. If they're above the red line, the cycles are biasing to the upside. Take a look at what happens when the market makes a higher high in this double top. You can see the cycles are starting to fall and become biasing to the short side well before the market falls down. You could say cycles in some cases are a leading indicator. You can see here the cycles are starting to bias to the upside now. The cycles are starting through this sideways consolidation phase in here. You could say that the cycles moved up, went a little bit back to the short side, but are moved up again and are biasing to the short side, indicating that the bias of the cycles is heading up now. We have another indicator that visually tells you what the cycles are doing. And that is the market sync bias. We call this indicator the market sync. It actually was designed to work on longer time frame charts. And we actually originally, Glenn designed it so that we were looking for out of sync situations. You could see how the market was heading up, but the cycles were heading down. So it was kind of out of sync to the move. And when that happened, it's wonderful. It's wonderful when that happens because you're showing downside cycle movement to upside price movement, and that precedes moves down. Like, it works way better on longer term charts. I'm showing you this on a shorter time frame chart. This indicator market sync bias is a color representation of the cycles. So when the cycles are below the zero line, when the cycles are below the zero line, the indicator turns red. When the cycles are above the zero line, the indicator is green. So you can use it that way too. There's another thing that the market sync bias does too. Just let me turn this to true. True would help if I spelled it properly. Hit OK. You can see here when the dots are actually, they can be above zero but heading down. The market sync bias indicator will paint red. If the dots are even below zero and pointing up, the market sync bias indicator will paint green. Again, it's mainly designed for longer time frame charts, and I'm just going to show you a longer time frame chart, like I don't know, what do we want to choose? Let's choose a 30-minute, just for the heck of it. See what happens. We're building data here a little bit. Let me just look for a clean example. Right here. Here's a couple of clean examples right here. The market bias is short. The bias turns green or goes up to the upside here. Let me just turn this back to true or false, sorry. So we can see the cycles crossing the zero line. And we can see, look at how nice this is on the longer time frame chart. Look at how the colors change during near the lows. Almost right at the lows and almost right at the highs here. You can see the cycle bias is changing direction. Here you can see the cycles crossing the zero line to the downside, becoming negative. And so it's actually excellent analysis something that you need to include in your long-term analysis. Um, Cycles, um, two indicators for you that we offered to measure those. That's it for cycles. Thanks for listening to the little movie, everybody. Bye.